This is your host, Pete Moore, and I am pleased and humbled to announce the launch of my one and only book, Time to Win Again. 52 takeaways from playing and watching team sports to ensure your business success. Those of you who know me personally, and anyone who listens to Halo Talks for any length of time, know that I am an avid sports fan and a big believer in the value of team sports. What I've seen over the past 25 years helping businesses grow, raising capital, being an entrepreneur myself, and coaching and mentoring executives in the sector, it's the lessons learned on the field perfectly apply to business. Entrepreneurs, executives, managers, you name it. Every company that's a strong company has got a good team. It's a quick read. There's awesome illustrations in there from our good friend Mark at Cruelty Free Cartoons. If you go to integritysq.com, enter your email address, and we will send you information on the book and the Entrepreneur's Survival Kit as well. Be great. Take names. Go Halo. This is Pete Moore on Halo Talks NYC, on location, Dallas, Texas, with a good and old friend of mine, Rich Steere, New Heights Capital. Welcome, finally, to a Halo Talks.
Thank you, Pete. It's good to be here. Good to be in Dallas at Ursa again.
So you were one of the original investors in the health club industry, as I like to say. So you were one of the first movers into what we now call the HVLP 2.0. Now you've got some Orange Theories and you've done some other interesting things in and around the Halo sector. So why don't you just give your background first on the banking side and then turn it into a private equity guy, and then we'll talk about the industry and the nuances of it.
Yeah, so I started in the industry as a M&A advisor, helping privately held companies raise capital or sell, and I was an industry generalist and did that for 10 years. And went out to search for a business to buy and invest in. And I had a group of investors who were former clients who I'd helped cash out of their business, so they had capital to invest. And pretty quickly into that search and process, I was introduced to a group of entrepreneurs that happened to be the Fitness Edge and the Edge Fitness Clubs, and went up to Connecticut and met them, and was really impressed by what they had built and their passion and talent for the industry. And so I was not a fitness expert or had experience in the industry before, but they absolutely had elements of a good business and good partners. And so we were able to, strike a deal. We invested. We bought control of the company, and the original founders, who were brothers, Jim and Vin Sansone, stayed on. And we went through a period of time where, that was in 2008, where we had to kind of restructure the company and come up with what is today the Edge Fitness Club, the HVLP model. Mm-hmm. And that really started to take off and grow, and we began kind of the early elements of scaling that company. And, we were partners for 7 years, and New Heights sold that business and moved on and has stayed involved in the fitness industry. We've invested in Orange Theory Fitness at the franchisee level. We are investors in Fresh Meal Plan, which is a freshly prepared meal service that has been focused on gyms in the fitness sector and active lifestyle. We are co-investors in ABC Fitness, which is kind of the predominant billing company to gyms throughout the country. And we are now kind of early supporters and investors in Restore Hyper Wellness, again, at the
I didn't know
franchisee
that.
level.
We got franchisee or franchisor?
Franchisee.
Okay, we'll talk about that privately, because we're working on something on that front. So let's talk for a minute about, rewind the clock. You go and you meet with the Sansone brothers. They've obviously got a nice mousetrap. They're generating strong unit economics. What's your, what did you provide to them that they couldn't do on their own as entrepreneurs?
The business was also at that time less mature, less sophisticated, less data-driven. And that was actually a kind of a good time, right fit for me, coming in with financial skills, analytical skills, and the ability to kind of crunch numbers and help them look at the business quantitatively. So they bootstrapped that business. They started in the 80s as Gold's Gym's franchisees. And so they're true gym guys. And so they were at an inflection point where they still wanted to move on with the industry, still wanted to lead in the industry, and they needed a partner who brought the skills that I had that could help their business and really take it from a collection of clubs and brands into an enterprise and help them manage that enterprise, not only financially, but from an organizational standpoint with people and disciplines and overall kind of just brand development.
Yeah. So in a lot of businesses, you see the entrepreneur kind of takes a business, can grow it to a certain level. At some point, they look at their personal balance sheet and they say, all right, I'm on the hook for 10 leases. I'm on the hook for these 10 loans. The business is generating EBITDA and things are going well and there's money in the checking account. However, there's an overhang and I probably can't really grow, off of my own personal balance sheet anymore. So talk about, your relationships with debt funds, bringing in this institutional capital and how conversations with landlords and debt financing sources change when somebody like you gets involved.
Absolutely. That took place with Fitness Edge at the time. Those guys were personal guaranteed on leases. They were, in the midst of taking on Planet Fitness as a major challenge in the industry and coming up with the Edge Fitness Clubs as a response to that, where they could still lead and grow. And, they had to think back and reflect upon their own partnership, their own personal balance sheets, and how much they would be willing to risk to continue to grow and take on bigger spaces, bigger leases. And so when we invested, yes, we brought in equity capital, but we also brought in a lending partner, and we were able to present the business at a holding company level. So where before, maybe landlords would have looked at them as partners in different gyms, they were now able to kind of see a holding company and release, in certain instances, those personal guarantees. And absolutely going forward, that afforded the company and them personally, as kind of the leading executive of the businesses, no longer to have to extend themselves personally on leases, or for that matter, any more than kind of their pro rata ownership to invest and grow in new locations. So I think that was a really significant milestone for them, where we were able together kind of accomplish that goal.
So, and we've talked about this on several podcasts before, but, when private equity comes into a business, there's no one from the private equity firm that's signing a personal guarantee. There's no debt that's recourse debt. And what I've used as an analogy is, you and I are playing with a chess or a checkers board, but I'm playing chess, or in this case, you're playing chess, and me as an entrepreneur, I'm kind of playing checkers on the same landscape, because you can grow much faster than I can, because I'm not looking at what my personal liability is, where you're setting up and saying, hey, it's a portfolio company, and this portfolio company kind of has to stand on its own.
That's correct. And then also, from an equity standpoint, we're bringing a group of investors, right, that are either our investors, our limited partners to the transaction. So that helps diversify the risk as well. And it also, helps, or at least it presents to landlords that there is a point with which you can no longer kind of jump over the wall and ask people to personally sign. So the business has to stand by itself and the balance sheet has to stand by itself, but it certainly helps when you've got a strong equity partner that's got experience in capital.
Yeah. So how do you, when you take a look at whether it's the Edge or you look at other deals, a lot of entrepreneurs like to run their own business, and that's why they started the business originally. So the question is, when you come in and say, hey, look, I think this business is great, I think this entrepreneur is great, but I don't think they're ready to have a partner. How do you think through that, or like how is like your sense of like, hey, I get what they want to do, but I'm probably not the right person, or I'm not the right firm to do that, because I don't think they understand what the relationship is going to be going forward. How do you think about that?
Yeah, I think one of the first ways to observe is that partner, or is that operator ready for a partner, is what have they done in growing their business? Have they had to bring in outside talent and executives to the company that they've been able to basically elevate within, promote within, delegate, give responsibilities to, so it's not just 100% controlled by one partner or two partners that have started the business? Have they brought on any outside capital or any lenders at all, even if it's a local bank that they've had to report to? And I think also the other part is, what have they been doing from a reporting standpoint? Are they creating transparent financials? Maybe if it's not even shared in the organization, but between themselves and their accountants, is that a discipline that they're used to? And do they use financials and quantitative metrics to manage their business? Because for sure, you're going to need to be able to communicate that way to your outside financial partners and to your board and to the lenders as well.
Got it. So assuming they have some of those, or at least some tea leaves of that gives you a little more confidence that, hey, we're going to have meetings and it's going to be constructive and it's going to be quantitative, not, qualitative, I guess.
Yes. And again, that they've done things through the development of the business and the growth where they've had to, relate to outside parties and bring in some of those outside parties as inside partners. And again, that can just be employees or hired executives. That shows that they can both lead and be a partner. Gotcha.
So you've done minority deals, preferred deals. You've done structured equity deals. You've probably done some heads up common equity deals, but you're the majority control investor. Yes. And I've seen in a lot of transactions where the entrepreneur sells their business, they sell the majority control of the business, they get a liquidity event, and then the next day they show up for work. They think that they're basically renting capital, but they really have an employment agreement and they're working for someone else. So how is that, evolved, and how upfront are you about, hey, look, this is how this is going to play out over the next 3 to 5 years, and just kind of set the table of, here's like our rules of engagement?
Yeah, I think, if you went back to the early days in the industry and where the sector was not as well covered from private equity firms, then there was not necessarily the awareness from the operators or the entrepreneurs about what these partnerships would be like and how they would work. And so they've heard stories, okay, you're selling your business, and so you've lost control of your business, and you are just really under an employment agreement. And, the industry has changed so much, including overall private equity, where there are many more choices for entrepreneurs and operators, and they really kind of control the table about what they want for choices, both from a valuation as well as some of the qualitative factors. And so, when I think from an entrepreneur's perspective, where that matches up to the investor is, again, it goes back to the leadership, is does that individual, even if they've now going to be a minority shareholder, will they have the passion and the drive because they still view this as their baby, and they view the financial partner as, while being in control, really the operator is in control because at the board level, the financial partner, the private equity firm, doesn't really want to step over and get involved in the day-to-day operations. So, ideally, a private equity firm should be complementary and supportive from a strategy standpoint, as well as whether it's on external M&A factors, doing acquisitions, helping set up incentive plans for employees, which probably didn't exist in the company before. So, I think that those are the good ways that a private equity partner can come in, buy control of the business, and still have a highly motivated, engaged, and ultimately deferential relationship to the former control owner, and most likely that control owner is the CEO of the business.
Yeah. So, as you've gone through, I use this term a lot, experience is what you get when you don't get what you want. So you've got a lot of experience looking at different companies and different situations. When you are, whether a majority control or a minority control investor, how do you eloquently say, like, look, I've seen this movie before. Let me kind of tell you where it's going to lead, and trust me that, this is an analogy that we're about to enter into. Or like, how do you kind of talk to entrepreneurs knowing that this is like their first time with private equity, and, it's obviously personal to them. At the same time, like, there's a playbook that you have.
Yeah. Well, I think maybe starting with that playbook is it's an imperfect playbook in the sense that it's a guideline for how you want the relationship to work. It's a guideline for how you see the business performing over the next 5 to 7 years, which is probably the timeline you're thinking about before you would want to sell the business. And so that's an important part of investing, is, do you have a vision for when you can sell the company? And, so a lot of this is discussed and strategized and planned, but then you've got to kind of get into the partnership and stuff happens, like you said.
Right.
So you have that experience. And so I think to guide an entrepreneur through who that partner could be, and, it does, I think, come down to some reference checks about what they've invested in before, what that experience was like, and when they face tough times, how did they work through that with their partner? And then the second part, which is important and is one of the harder things, particularly at the kind of middle market or lower middle market stage, is you are moving from privately held, tightly controlled decisions to now making decisions for partners that are outside the business, that are counting on information, but also have great influence at the board level about how those decisions are made. And so I think that's a really big difference and can determine the success or failure in a partnership and the growth of the business. And so, from a operator or CEO who's partnering with private equity, their ability to drive the business and show to the board that they have command both over the organization as well as the financial performance and really some of the key KPIs, that communication and the efficiency of that on a regular basis to their partners is critical to keeping that confidence.
Yeah. So, as you kind of touched on, things are going to happen, whether it's COVID, whether it's a financial crisis. A client recently said, how am I going to diligence these private equity groups that you're introducing me to? I'm like, you just have to call 3 of their portfolio companies and see if they really were flexible capital or not when they stop getting their interest payments on these unitranche debt deals. So, how much do you protect your personal and your New Heights Capital brand, and how much does that matter to getting other deals in the future?
And the protection of that brand is in what? In terms of how you
like,
might defer returns on capital or restructure things?
Or just, basically making sure that you're very clear and transparent with the entrepreneur and the portfolio companies that you have, and that knowing that those portfolio companies at some point is going to be a reference check for the next deal that you want to do. And, what feedback do you want to have? Or maybe it's better to ask you a question. If somebody was to call a group that you've invested in and sold, what would they say about you?
Yeah.
To answer that.
Yeah, I think it's a good question. Obviously, we're a small firm. We're industry focused, primarily on consumer services, a lot of overlap in fitness and wellness. So that reputation is extremely important. You need to be able to have really good references to be invited into the next opportunity. So, the way that we approach investments is trying to be value add from an industry standpoint of having had experience growing from a privately held business to an institutionally ready and scaled company that's now demonstrated success and has the metrics and the financial reporting in place for kind of that next generation private equity firm. So we are, I guess you could say, kind of a roll up the sleeves partner that isn't necessarily just above and at the board level where everything just shows up in a package, right? It is you are helping that business, you're helping those partners come along the path to be able to accomplish some of the things that we talked about early on in terms of the transparent reporting, understanding the communication, and then also just setting up the organization with the right people to help that entrepreneur and help that operator have the bandwidth to not only work in the business, but work on the business at an enterprise level. So I think that's our niche is in that stage.
I want to take a minute and tell our audience about 2 awesome workout recovery products I've been using for the last 18 months from higherdose.com, leader in infrared technology for athletes like all of us are. We're an investor in the company. That's not why I'm telling you this. I'm telling you this because it works. You got an infrared hop in there. I'll listen to some podcasts, burn 800 calories, get a mad detox, and a PEMF, which is a pulsed electromagnetic field crystal mat that I lay on and I recalibrate my cells to the normalized level of the earth. If you got somebody you like and you're looking for a pretty awesome gift, they will love it. You could use this code HALO75, get $75 off, and you will not be disappointed. HigherDose.com, promo code HALO75. And now let's get back to our regularly scheduled program.
When you think back to, take the Edge or some of the other deals you've done, when you made that investment to see where the company is today, obviously there's a financial return, and those returns have been very strong for your investors. But at the same time, you basically helped build a chain that, was in Connecticut. Now it's in 4 or 5 different markets, got NEP as their, institutional capital provider. There's probably hundreds of thousands of members at these locations that now have a place to work out. So how do you think intrinsically about, look, you're a finance guy and you're putting money to work and you're an asset manager and you're getting people returns, but at the same time, working in the Halo sector is giving you ancillary, rewards, because, you could sit back and say, hey, look what I've helped build, and look how many people it's affected. So how do you think about that when you kind of look at your career to date?
I think, personally, there's a lot of pride in first the partnership. If you want to look at the Edge Fitness Clubs and helping them, build that business in a way that they probably were not going to go pursue. It doesn't mean that they couldn't have done it, but they probably wouldn't have pursued it without having an outside partner come in and, be at the table with them at that point, really day to day, talking about how are we going to build this business? How are we going to work through these challenges? How are others going to look at us from an investment standpoint down the road? And so these, those guys, Jim and Vin, and the rest of the team had great instincts for how to build the company and build the product. But they absolutely needed help from the back end from a corporate enterprise level. And so, that is what I brought to the table. And so I still have, a lot of confidence in the brand and the business that those partners continue to be involved in with NEP, and build out, continue to build out even now through COVID and beyond. So there's definitely some pride in having been a part of that, and knowing that as a partner, that the skills and experience that I brought to them are still relevant to other businesses today. And we continue to, kind of run that same playbook with different types of businesses to help them build. So, and I think we're fortunate to be in the Halo space, because you feel good about what you're doing, right? You are helping people help themselves. Yeah.
So, given what's happened on the connected fitness side and some of these venture capital firms that have put boatloads of money in at, multiples of revenue or just multiples of nothing, to compete with the industry, how do you stay disciplined in your, quantitative approach to transactions, and, basically say, hey, I love this company, I just don't love it at this valuation, or, this management team, they might take money at this value from this type of firm, but they kind of don't, they're basically setting expectations that they might reconsider, down the road, because, they're selling someone a business that is not going to really perform the way, this hockey stick of projections work. So how do you stay disciplined and say, hey, look, I'm a growth equity investor, I'm an LBO, and as much as you tell me that that valuation methodologies have changed, I've been through 3 or 4 cycles myself, and they kind of don't, so how do you kind of stay disciplined and not get brainwashed that, there's a new normal now? Is there ever a new normal or not?
I absolutely think this is a new normal that's just been a long-term evolution in the sense of the amount of capital that's covering the sector. And so there's a scarcity of ideas, concepts, and companies. And so that's driven up valuations. But, from our perspective and my outlook, just take the example of ABC Fitness, that was a company that traded at a very high valuation, but it brought scale. It had tremendous market.
And it had EBITDA.
Market share. Yeah. It did have, EBITDA and a strong track record of performance and growth. And so for me, that's worth a marquee valuation and premium to get into an asset in a company that I knew well, versus, let's just talk about Connected Fitness, where basically they are the beneficiaries of being on trend, having a lot of capital that's looking for places to go, and those investors are structuring their investment where they're not necessarily partners in this from a capital standpoint. They always come in with a preferred, and so there's a huge headline number from valuation, and they're just taking a swing, and they know they've got kind of the first round of capital out of the business. So that's in general a bit different than what we would like to approach, where we are more engaged as partners with the groups that we're investing in.
So just for an educational note for our listeners here, when a Series A round gets done and then a Series B round, the Series B round has the liquidity preference over the Series A, and the C and the D and the E. So there's basically a waterfall where the money goes back to the last in, first out on the capital side. And in this environment of chasing deals and valuations and a fear of missing out, you might give someone a high valuation as a flyer, but at least know that you're somewhat, hopefully, protected. As the first money back. In a worst case scenario, who knows what that worst case scenario turns into or what the business is worth. But there seems to be a lot of follow-on investments and a lot of sticker shock on, at least from my standpoint, on valuations that might not be supported by the actual company at this point.
They're very frothy valuations and hard for us to justify, given the way that we've invested and partnered in the past.
Mm-hmm. So, from a standpoint going forward here, obviously in the blue states that you're looking at or that you're invested in, there's a different recovery curve than there is in red states. We've had investors call us up and say, don't show me anything in a blue state, for at least 6 months. If you got some red state deals, I'll look to do that. Has that ever been an investment criteria? And do you think going forward, you're going to start to look at what's the state political environment, with whether it's in a halo company or whether it's in a retail business? Because I never really calibrated that. We used to do country risk back in the day, right? Like, what's the volatility of Brazil? And, but not, you didn't say what's the volatility of California versus Texas or Florida. I feel like that's almost a financial risk return CAPM model back in the day. Capital asset pricing model. Right. There you go.
Good one.
How do you think about that?
I do think that it's shifted to a cultural consideration where before I think that folks looked at California, which we're invested in, and some people would resist investing there because of the assertive regulatory framework within the state, and then just the overall higher cost of labor.
Yeah.
The way we kind of think about it is the labor is higher in California, but California is its own ecosystem, and we're selling a consumer service to that local economy where the locals benefit as wage earners that have higher earnings and higher wages to be able to spend back into consumer services. Right. So I think that for us has not been a risk. I think COVID has certainly demonstrated that a more assertive government can get involved in your business in ways that you would not like. So do I think it's a factor going forward? Yes. That being said, there are certain states like California that are tremendous economies, have great appetite for fitness and wellness services, and will be great investment opportunities. But it does take, I think, a higher level of execution and operating partners than you could expect in states that are going to be more lax.
Yeah. So, let's say somebody said, hey, I'm looking at this deal in New York or California, and this, recovery trend that the bankers are telling me, is on this diagonal trajectory back towards pre-COVID numbers. Yeah, it's just not happening yet. So what's kind of your crystal ball for, when there's some kind of level of normalcy? And do you kind of, long term, I think over a 5-10 year period, obviously the sector should be fine and benefit. Who knows what the competitive landscape is going to look like? But how do you think about investing today if you had a deal, or say, you know what, I'd rather just wait 3, 6, 9 months and I don't want to have to underwrite that risk, or I will underwrite it because I get a better deal. How do you think about that?
I think today the market is discounting because of COVID in these sectors, particularly fitness, so that you can get a discount. I don't know if you're getting a deal because, again, there's plenty of money to go around that has covered the sector. They're familiar with the assets, and so they are ready to invest, and they are expecting accordingly a discount. But there are not, I would say, steep deals. But the outlook, the way we think about it is we have to be prepared for kind of steady state through the winter here between 21 and 22, and then we expect, coming out of, like, let's say winter or early spring, to see a trajectory like we saw in February to July of 2021, where the business will continue to recover, and somewhere between 90 to 100% recovery.
Yeah, great.
And I think the leaders in these markets that have hung on and have had strong operating disciplines and an important part of the recovery now is your human capital management, taking care of your leaders in whether it's the gym management, whether it's studio management, whether it's your regional management. Labor is scarce, like in everywhere else in the economy. So you need to be able to keep your team together. You need to keep them motivated, and that's a key differentiator in how you're going to recover. Is keeping your team together and keeping them motivated. So, I think that's not easy to do, especially for distracted owners or operators that haven't invested in their own infrastructure to support the growth of their business or the recovery of their business. And so the stronger will, I think, come out of this stronger, or the strongest. And so, we think we've invested in great teams and platforms that will, make the difference between getting to 90% recovery to 100% plus.
Yeah, no. And I know so many assets, so I believe that you have invested in great managers that make good decisions. So in closing, you got any quotes that you, business quotes or things that come up at a board meeting where they're like, that's a Steereism, or...
we would talk about this in the Edge, and I still use it as a famous Mike Tyson quote, which is everybody has a plan until they get hitting the first punch, right? And so that's what happens in life is you have a plan, and you go in as partners, and then you get hit. You get knocked down. And then how do you respond? And how do you keep it together as partners? How do you keep it together for your business and get back on your feet and re-strategize, take a deep breath, not panic, and plan as partners, and then start to communicate that to the rest of the company of how you are going to proceed and move forward. And in any business, you can have multiple plans, and maybe one's the perfect one, but you're not likely to pick that. But several of them will work, and it's just the likelihood of success will depend upon your alignment to execute together.
Yeah, I've seen most success stories is when ownership and management are aligned, good things happen. It's usually ownership that sometimes crushes businesses, but the right private equity group or the right individual on a board to say, let's make the right decisions, let's not panic, and let's take a long-term view. And I think that's kind of how life works, take a long-term view.
And maybe just add one more thing, which because I have been involved in the industry and invested particularly on kind of the brick and mortar brands, whether they be independent or part of franchises. It's harder for financial investors sometimes when they're first getting involved to understand the intuition of the entrepreneurs in this sector about how they sell and they grow their businesses. And I think that's kind of an important learning point, is it's really hard to bring someone in at a top level executive and just take over the company and say, I saw what these guys built, but I don't like the way they do it, and it's a little bit hard to understand. Let's bring in our own team because they get it. They did it in this, they did it for Pizza Hut, and they can do it here. But it's never actually worked that way. So you can bring in an executive to partner with the entrepreneurs that have built the business, but you have to respect the culture and give them some leeway and bandwidth to, both work within the requirements that you have as a financial investor with regards to information and data, but you've got to also flex your systems and requirements to allow them to have that, to sustain that culture, because it's a people business. And it's really important. And that part is sometimes misunderstood by investors.
Yeah. I think a lot of private equity firms want to institutionalize a business. And I think from what you've done and from what other people have done is you kind of have to be like an entrepreneurial financial partner. I understand that you're backing an entrepreneur. You're not backing this robust, seasoned management team that has these credentials, but they're street smart. They know how to make money, and you got to support them. But you also got to, maybe put some guardrails up on the bowling alley. But you got to let them take big swings at the pins.
That's a great analogy. I like that.
Yeah. Great. So good to see you again in person.
Great to see you in person.
Let's look to some deals together, and glad everything's working out. And you've been a great asset to the industry. So keep staying in the halo sector. Don't venture out into anything too extreme.
I won't. I enjoy this sector, and it's even through COVID, it's nice to see that there are emerging trends, whether it's been through digital connected fitness, or now what we see more on the recovery side, and fitness starting to incorporate some of those recovery aspects into their own business, but also standalone recovery businesses thriving too.
Agreed. So. Awesome. All right. Thanks for coming on.
Thanks,
Good to see you.
Bye.